Welcome to Wealth Path. We're glad to be with you on this journey to grow wealth and achieve financial freedom together. In this video, we'll cover why invest in real estate, what to expect as a new investor, and how to calculate the finance part of real estate investment. Real estate has been a proven way to build wealth, but it can feel overwhelming at first. So, let's make it simple. If you haven't subscribed to our channel, do it now by hitting the subscribe button below. We're posting tons of research-based content about finance and investment. Now first, why invest in real estate? Real estate offers multiple benefits, including passive rental income, potential property appreciation, and tax advantages. According to U.S. Census Bureau data, real estate has consistently appreciated over time, with home values rising by about 4–5% annually on average. This long-term growth, combined with rental income potential, makes real estate an attractive option for many investors. Another key reason is diversification. Real estate often behaves differently than stocks and bonds. It can serve as a hedge against inflation, making it a distinct and versatile addition to an investment portfolio, meaning it can help balance your portfolio and reduce overall risk. Let's look at some common types of real estate investments and what each involves. Rental properties. Owning rental properties is one of the most straightforward ways to invest in real estate. You buy a property, rent it out, and collect monthly rent payments. You also benefit from property appreciation. But remember, being a landlord involves time and effort, from property maintenance to tenant management. Real estate investment trusts, REITs. If you're not ready to buy a property, REITs might be for you. REITs are companies that own or finance income-producing real estate across sectors like residential, commercial, and industrial. They're publicly traded on the stock market, so investing in REITs is as easy as buying a stock. House flipping. House flipping involves buying a property, renovating it, and selling it for a profit. While it can be profitable, flipping also comes with high risks and requires market knowledge, project management skills, and sufficient capital. Many beginner investors start with smaller projects to gain experience. Now, let's talk finances. Real estate can be profitable, but it's important to understand the costs and returns involved. Cash flow. Cash flow is the income you get from renting out a property, minus expenses like mortgage payments, maintenance, property management fees, and taxes. Positive cash flow means the rent covers expenses and then some profit. Negative cash flow, on the other hand, means you're paying more out of pocket. Return on investment, ROI. To evaluate a property's profitability, calculate your ROI, or return on investment. Calculate ROI by dividing your net profit by your total investment cost, then multiply by 100 to get a percentage. Here's an example of how to calculate the ROI for a rental property. Scenario 1. Property purchase price $200, 0002. Down payment $40,000, 20% of purchase price. Mortgage amount $160,000. Interest rate 4%. Monthly income. Monthly rent $1,500. Monthly expenses. Mortgage payment, principal and interest approximately $764. Property tax $150. Homeowners insurance $75. Maintenance and repairs $100. Estimated property management fees $75. If a property manager is hired, total monthly expenses $1,164. So the net monthly cash flow is $1,500 minus $1,164 equals $336. The annual cash flow from this property is 336 times 12 equals 4,032. Now, let's calculate the ROI by dividing the annual cash flow by the total initial investment. Total initial investment. Down payment $40,000. Closing costs estimated at 3% of purchase price $6,000. Total initial investment equals $40,000 plus $6,000 equals $46,000. So ROI is 4,032 divided by 46,000 is approximately 8.76%. This means that based on the cash flow and initial investment, the owner would earn an 8.76% return annually from this property, plus potential appreciation in property value. Generally, an ROI above 8–12% is considered good for rental properties, though this can vary by location and property type. Leverage and financing. Real estate investing often involves leverage, using a mortgage to finance your property. While leverage can boost returns, it also increases risk. If property values fall, or if you have trouble renting, mortgage payments can strain your finances. It is recommended that you maintain a cash reserve to cover at least 3 to 6 months of mortgage payments and property expenses. For the example above, the monthly expenses are $1,164. So you'd need to cash reserve of $3,492 to $6,984. Before buying any property, do your research. Here's what to look for. Location. The saying, location, 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 exists for a reason. Areas with growing populations, strong job markets, and good schools tend to see higher property appreciation and rental demand. Many websites provide housing market reports by location, which can give you insights into appreciation rates and rental yields in specific neighborhoods. Property type and condition. Consider the property type. Single-family homes, multi-family units, or condos each come with different costs and responsibilities. Also, assess the property's condition and whether it needs renovations. Older properties may offer good prices but come with higher maintenance costs. Rental demand and rent prices. Check out local rent prices to estimate your potential income. Websites like Rentometer allow you to compare rent prices for similar properties, which can help you determine if your target property would be profitable. Real estate offers many opportunities, but it comes with risks too. Here are some common mistakes to avoid as a beginner. Underestimating costs. New investors often overlook maintenance, property management, and vacancy costs, which can affect cash flow. For single-family rentals, it's typically to budget in 4% to 6% vacancy rate, while for multifamily apartment, it is typically 5% to 10%. Make sure to budget accurately. Over-leveraging. Taking on too much debt can increase your risk. If your rental income doesn't cover mortgage payments, you may face negative cash flow problems. Keep a cash reserve and avoid properties with a high loan-to-value ratio. Skipping market research. Failing to research your target area or property type can lead to poor investment decisions. Thoroughly evaluate market trends and potential returns before purchasing. As a beginner, remember that patience and research are key. Many successful investors start small, learn from their experiences, and gradually expand. And that's a wrap on our beginner's guide to real estate investing. Real estate can be a great path to building wealth, but success requires research, planning, and careful budgeting. Let us know in the comments if you'd like us to dive deeper into any of these topics. And if you found this video helpful, please like, subscribe, and hit the notification bell for more insights on investing for beginners. Thanks for watching.